This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning a couple noted market commentators. Ty Andros, the president of TraderView, publisher of the TEDbits website, and writer and editor of his well-recognized newsletter, also named TEDbits, no stranger to all of our listeners. But we also have with us Bert Dohmen today, who's been with us before. Author, investor, publisher. Bert, you're involved in a lot of things, right?
Yes, I try to keep busy.
Oh, yeah, that's for sure. Bert, could you give our listeners some of your background, the things you are involved with?
Okay, I founded Dohmen Capital in 1977, so we're now in our 36th year of business. Started in January 1977 with the Wellington Letter. And it was really a very fortunate time because only 3.6% of all the analysts, the investment advisors, were bearish, according to a survey by Investors Intelligence, the lowest number of bears they ever had. And I saw all the negative signals, and I started predicting a bear market. And that's actually when the bear market started, and we got some good publicity in the Wall Street Journal. So that really launched our business. We do only investment research and sell it via subscription services. We do not manage money. We don't sell stocks. We have no conflicts of interest. And, we can even say sell and sell short, which is rarely heard on Wall Street. So that's why we're not on Wall Street. We've done very well over the years, and especially making money in down markets and bear markets.
Bert, I've just done a series of shows asking whether we are going to see Dow 20,000 or Dow 5,000, and if so, when. I'd really like to get your feedback, because you're very good at understanding technical analysis, and you're also very good at understanding how the credit markets themselves drive the performance. And if you're seeing anything and what you think's ahead.
I think with time, if you give it the next 20 or 30 years, yes, we'll see 20,000, we'll see 30,000, we might even say 40,000, depending on what inflation does. But I think over the next year or so, you're not going to see 5,000, you're not going to see 20,000. And I think we're getting closer to a very important top in the market. And if we're lucky, we'll get through the next 2 months without a major decline in the market. But going into next year, I'm bearish, okay, because economic fundamentals. And, I look very closely at consumer spending. Consumer spending actually topped out in May of this year, and consumer spending traditionally always tops out very closely with the stock market. So if consumer spending is tapped out, and I think next year definitely will decline with all the people losing jobs, having to pay much more money for their health insurance, you're going to see a continued decline in consumer spending, which to me means a decline in the stock market. We've seen a speculative bubble here to some extent in the small cap stocks. The Dow, as just a few days ago, tried to make a new high for the year, and it was turned back. And this was at a time that the small caps, as reflected by the Russell 2000 index, had the most overextended performance compared to the big caps that I have ever recalled seeing. So in other words, there was huge speculation of small cap stocks. And this is the hedge funds trying to make up for their bad performance this year. And I think they're still going to try to get some performance for the next 2 months so that they can collect their fees. After that, there's going to be, I think, a rush for the exits.
Ty, same question to you. What are you seeing going forward?
Well, I agree with Bert that consumer income is, going to be just murdered. And, if you think of healthcare as 18% of the economy and Obamacare causing everybody's healthcare bills to go up 20 to 100%, we're really talking about a hit. And when everybody's going from 40 to 30, and that fundamentally the economy, top line revenues, bottom line profits are in free fall. Actually, in Bert's last letter, he had a nice chart showing how the S&P actually has no profits if you subtract financials. And, we're in a profit wolf wave, which I actually covered in, my last edition. And actually, it was the same wolf wave that I used in 2007 to predict the crash into 2008. And the timing would say that we are going to have a real calamity into the fall of next year. That having been said, no one can conceive the amount of money that's being pushed into the stock market. The volume 80%, and then if you subtract high frequency trading, there is no real volume other than high frequency trading. And so we live in a very corrupt world where it's very difficult to predict things because the people that are in charge are, I'll call it totally insane. It's unsustainable. The credit's unsustainable. Everything's unsustainable. But these things die in waves of insolvency. And right now, they're willing to cover every hole with a helicopter drop. And we really misunderstand how the Fed has changed or is going to change under Yellen. And she is a Tobin, not a monetarist with a twist of Friedman, like Bernanke is. And she has total contempt for market prices and completely believe, Keynesianism for most people, it works best in a totalitarian society. And I would argue that we're, rapidly closing on that. And that as much damage is being done by Obamacare that we're able to see, equal amounts of damage being done to the financial system by Dodd-Frank.
Ty, could you expand on that just a little bit? Because I know that you're seeing that front and center, the impact of Dodd-Frank in your industry.
Oh, it's just murdering the small and intermediate-sized firms. Even if you're a medium-sized firm, you're actually looking to combine with another group to manage compliance costs. And people don't understand the extent that those regulations that have been written are now really, I'm going to call it squeezing. And, a large part of the Depression not ending was FDR put in place so many rules and regulations. Well, we've got that geometrically in this last 4 years. And it is just absolutely wrapping itself around everything. And it's squeezing and rewarding people for being productive or hiring people. Actually, you're punished for that. And so, we've been in a secular bear market since, Bretton Woods won, but it's really, I believe, going to accelerate hard here. And fundamentally, they may be able to put nominal prints up that show growth, wealth creation, and unit sales. It's not doing well. And of course, we have some anecdotes. We see the car industry that went through a depression and lots of turnover. But I can't tell you, I'm so bearish. But will people be able to see it because it's masked by the money printing? There's a great debate. And, you understand Keynesian illusions where not going up, but if you measure them purchasing power, they're going down. And, it's an epidemic. And when you say Dow 20 versus 5, I am confident that we are going to go touch the trend line from those, 2001 and, the, 2008 lows on the downside, that big wolf wave, and I believe we'll see Dow 5,000, no doubt. And I've got S&P 500 or 450. But when do these divergences manifest themselves? When does the record margin debt fail? When does it turn? I don't know, because she doesn't care if there's inflation. She doesn't care as long as she's hitting her, I'll call it her numbers. This woman is really a very stealth poison. Bernanke was improvisational, and he was a Friedmanite, but she is not. And she is, to me, a monster. But she's just an academic that has been cloistered. She's, like I said, she's a Tobin Keynesian. And that is not a Chicago school Friedmanite kind of guy that Bernanke was, and he is.
Bert, can I ask you, what should investors do? Not trying to give people investment advice, but conceptually and generally, what should they be thinking about?
Yeah.
What should be in front and center on their minds right now?
The first thing you should do is find an advisor who knows what's going on, okay? Somebody who can guide you through this. For example, I spend about 12 hours a day, sometimes 14 hours a day, on analyzing the markets and so on. The average person spends maybe 5 minutes a week. You can't do it in 5 minutes a week. You need good guidance. And to find the right advisor, just ask them, how did you do in 2008? Were you up or were you down? If they were down, especially if they were down sizably in 2008, I would look somewhere else. I think somebody that figured out 2008 that it was going to be a very bad year in the markets, that's the kind of guy that you want right now, because I think what's ahead is going to be another bad year in the market. And you can make big profits in the down year. Have you ever noticed that stocks go down faster than they go up? So you can make a lot of money today with the inverse ETF. It's so easy. You don't even have to figure out how short selling works. They do it for you. So you just buy the ETF and it rises when the stock market or the sector declines. That's the way to go. There are great opportunities coming up. And, the best thing that I like always in the down market is because it's not so crowded on the downside as it is on the upside. So that's what I suggest.
My rule of thumb, Bert, is 3 months of gains are typically given up in less than 3 days. And we may see 14 or 16 months of gains given up.
I'm glad you pointed that out, Gordon, because, on October 9th, that was the low of this latest down move that we had on October 9th. The Dow was actually below the level of May 5th this year. Can you imagine? And most people thought that the stock market was rising. The small caps were rising, but not the Dow. These are the big cap stocks, and that's really much more important for the economy. So here, in just a month's time, it'll wipe out all the gains of the prior 4 months.
Exactly. And that's why your point is very valid. You need some real advice and guidance to play the market. It's a very dangerous one when you're shorting, or it can be. Ty, what would you advise?
I completely believe that there's a crash coming, but from where and what's the catalyst?
Well, you have to use technical analysis to catch the turning points. Only technical analysis.
But how many? But Bert, tell me, how many of your sell signals are failing right now?
The traditional signals, they're not as dependable anymore because you get so much intervention by the government. They've got this, the official name is the President's Working Group on the Financial Markets. It was formed in 1988. It was signed into law by President Reagan. And so they've got this group sitting in the basement of the Treasury building, and they actually are able to, as they call it, preserve orderly markets. That's the official statement. And they go into and buy the index futures to support the market. And that was their original mission.
Of course, that wasn't what it was supposed to do. It was supposed to be during crashes.
Exactly. But now I think it's been mission creep, as they call it, and now their mission is to boost the stock market. Very simple, and I think that's what they do. And that's why, some of these signals are, sometimes many of these signals are failing. Like a rising wedge used to be a very negative formation. It isn't anymore. It just doesn't work anymore. So we have to adjust our parameters and so on. But I don't know anything that works better than technical analysis. It's not perfect in this kind of an environment, but I don't know anything else because technical analysis really measures money flow. Money flowing into the market, money flowing out of the market.
You guys have been in the markets long enough to know that these charts that we're seeing, the stocks are like the Russell 2000, are absolutely insane.
Yeah. Take a look at, here, if you take a look at the long-term chart of the S&P going back to 1995, and you see this roller coaster ride during that time, and I think it was about two weeks ago, there was an analyst on TV, and he said, we are now at the start of a powerful 4-year bull market. And you take a look at that chart. It's been going up for 4 years, and you say, this is the start? You know, I mean, you really have to question that. It doesn't look like a bottom to me. You know, big bull markets start from bottoms, not from tops.
I mean, Amazon.com, a big company worth tens of billions of dollars and doesn't have a dime worth of profits, or Netflix. Okay.
I wrote this very much like 1999. You know, the best performing internet stocks had no earnings.
Yeah, not last time we saw this, 99 had no earnings and nobody cared, but suddenly everybody suddenly cared. We have to break, guys.
Okay.
I appreciate you sharing your words of wisdom and your research with our listeners, and I'm sure that they will appreciate it. None of the discussion today should be taken as investment advice. Please check with a professional investment advisor, and I think the selection of your investment advisor today is probably the most critical decision that you're going to make. Guys, until next time, thank you for your time.
Okay, thank you very much. All the best to you and your listener. Okay.
Thank you.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.